Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. The Nasdaq surges to fresh highs, but a shadow war is brewing. Consumer confidence plummets and smart money quietly flees tech. Is this a bull trap before a market correction? Second, Wall Street declares war on crypto. Nasdaq and exchanges unite to block a tokenized stock backdoor, triggering a high-stakes battle with the SEC. Crypto firms are demanding an innovation exemption to bypass decades of rules. Will the SEC cave, rocking global finance? Or will the old guard crush the rebellion? Finally, shocking reversal. Warner Music partners with the same AI it sued for theft in a high-stakes bet that could double the value of its entire music catalogue. This isn't a truce, it's a power play. While superstars could see a new revenue surge, is this the end for emerging artists? This deal could trigger a bloodbath in the creative job market. Listen up, folks. The markets are at a critical junction today. With the Fed's potential rate cut looming over us and big tech making monumental AI investments, we are staring down a pivotal moment. The Nasdaq has surged to fresh highs, but don't be fooled by the surface calm underneath. There's a storm brewing. The S&P 500 is riding a 12.98% gain year to date, but has dipped 1.09% this month. This is your wake-up call. Navigate wisely or risk getting caught in the crossfire. The S&P 500 closed at 6,800, 12.61, up 0.69% yesterday, while the Nasdaq pushed ahead by 0.87%, driven by a tech rally. But this isn't just any rally. It's fueled by a massive $405 billion AI investment from big tech. Yet, despite these gains, the winds are shifting as consumer confidence plummets to a 7-month low. The market's positive momentum masks a precarious setup. The Magnificent Seven stocks now embody 36% of the S&P 500's capitalization, raising serious concentration risks. Here's the deep dive. The Federal Reserve's December rate cut probability is at a staggering 83 to 87%. This is the most anticipated monetary decision of the year, and it's causing a flurry of repositioning as traders brace for impact. With holiday retail data around the corner, a weak showing could tip the scales toward a rate cut. However, remember, a surprise hold could send shockwaves through tech-heavy portfolios, triggering a sell-off. The bond market's already jittery, as evidenced by the 10-year Treasury yield holding at 4.01%. And let's not forget, the VIX is compressed at 18.56, signaling low volatility expectations, but with a potential for a sudden spike post-FOMC meeting. Money flows are telling a story of their own. There's a tactical rotation from overvalued tech into undervalued segments like financials and energy. The Russell 2000's breakout is a testament to this shift. You should be on high alert for sector-specific turbulence. Remember, a narrow rally breadth is a precursor to corrections. Tech's lofty valuations at 27 to 29 times forward PE ratios are unsustainable unless earnings can justify this premium. History tells us these conditions precede sharp corrections. For those holding heavy tech allocations, it's time to de-risk and rebalance. Now, sector focus. Communication services led the charge yesterday, up 3.9%, driven by optimism in AI and digital advertising. Meta and Alphabet are at the forefront, but caution is warranted as these stocks face valuation headwinds. Information technology, up 2.5%, saw gains from Broadcom, up 3.26% thanks to its pivotal role in AI infrastructure. Meanwhile, consumer staples lagged down 1.3%, signaling a shift from defensive plays. Good advice makes you rich, bad advice costs you a fortune. Listen to me. Short-term, cut tech exposure by 15 to 25%, immediately rotate into financials via XLF and energy through XLE. Medium-term, accumulate AI infrastructure stocks like Nvidia and TSM, but be prepared to trim if big tech's capital expenditure guidance falters. For defensive strategies, hedge tech positions with VIX call spreads or SPY puts protect against a volatility spike if the Fed surprises us. Actionable steps. First, act now and trim Microsoft and Meta holdings, reallocating 5 to 8% to financials. Second, accumulate a 2 to 4% position in energy stocks like EQT and Valero, capture yield and geopolitical upside. Finally, establish a 3 to 5% allocation in Nvidia and TSM for AI infrastructure growth, but have a stop loss ready if guidance weakens. Keep your eyes on the prize. November's employment report on December 5, and the Fed's decision on December 10 will set the stage. If the 10-year yield rises above 4.3%, brace for further tech pressure. Your strategy today could define your December returns. Don't get caught unprepared. Time's ticking. Let's dive deep into today's critical market dynamics, ensuring you're equipped for the road ahead. And that road is full of battles. Our first story takes us straight to Wall Street, where a conflict is brewing that pits the world's biggest stock exchanges directly against the crypto industry. The World Federation of Exchanges, a group that includes giants like Nasdaq and Germany's Deutsche Börse, has sent a formal warning to the US Securities and Exchange Commission. The issue is tokenized stocks. These are crypto tokens linked to real-world equities, and crypto firms want to sell them to retail investors. To do it, they need a pass from the SEC, what the regulator is calling a potential innovation exemption that would allow them to experiment outside of traditional rules. What's really at stake here is the concept of regulatory arbitrage. You see, this is when firms exploit loopholes or differences in rules to gain a competitive advantage. By asking for an exemption, these crypto firms could potentially operate under looser rules than traditional exchanges, creating a fragmented market where the same asset is traded under different standards. That ultimately undermines investor confidence and could introduce systemic risks. But the established financial world is drawing a line in the sand. In a letter to the SEC, the exchanges argue this exemption could create serious market integrity risks and undermine investor protections. Nandini Sukumar, the CEO of the World Federation of Exchanges, put it bluntly, stating, "The SEC should avoid granting exemptions to firms attempting to bypass regulatory principles that have safeguarded markets for decades." The involvement of Germany's Deutsche Börse is particularly telling. When we place the US case-by-case approach alongside the EU's goal, the contradiction becomes clear. The European Union has already rolled out a comprehensive regulatory framework called Markets in Crypto Assets, or MiCA. It provides a single, clear rulebook for all participants. This creates a regulatory divergence, where global crypto firms might be tempted to shop for the most favourable jurisdiction, complicating cross-border capital flows and creating an uneven playing field for American and European exchanges. The core conflict is about fairness. We're seeing crypto companies argue that using blockchain technology could make trading more efficient, while at the same time, the exchanges are firing back. They point out that equity markets are already incredibly efficient, and they are still looking for proof that the benefits of this new model outweigh the costs and risks. Now, let's talk about that efficiency claim. Right now, US stock trades are settled on what's called a T+2 basis, meaning the final transfer of cash and securities happens 2 business days after the trade. The crypto world promises near instant settlement, or T+0, using blockchain. Interestingly enough, the established system is already experimenting. The main US clearinghouse, the DTCC, is running a project called Project Ion that uses blockchain to process around 100,000 transactions a day. So the old guard is essentially saying, we're already exploring this technology cautiously. You can't just leapfrog decades of risk management. This isn't just a technical debate. However, if you zoom out, you'll see another layer of strategy at play. It's not a simple case of old versus new, because actually many of these traditional exchanges are also exploring their own crypto products. This creates what the Financial Stability Oversight Council calls entanglement risk. The danger is that as the lines blur between the highly regulated traditional finance world and the less regulated crypto space, a crisis in one could easily spill over into the other, creating contagion channels that could threaten the broader financial system. The established guard is signaling that while they are pro-innovation, they will not stand by and let new competitors rewrite the rulebook. The message sent to regulators is clear. The principles that protect investors are not up for negotiation. What we should watch for next is the SEC's formal decision on this innovation exemption. That decision will not only shape the US market, but could also impact the global flow of capital into digital assets, affecting everything from stock valuations to the strength of the dollar. Speaking of how established industries are grappling with disruptive technology, our next story shifts from finance to music. But here, instead of a fight, we're seeing a shocking partnership. A seemingly impossible collaboration became a reality yesterday. One of the world's biggest record labels, just 1 year after suing an AI music startup for wholesale theft, has just announced a partnership with that very same company Warner Music Group, the label representing superstars like Dua Lipa, Coldplay, and Ed Sheeran, has officially settled its lawsuit with the AI firm Suno and is launching a joint venture. This is a complete reversal from the 2024 legal battle where Warner, alongside giants like Sony Music and Universal Music Group, accused Suno of profiting from copying existing songs. But that's not the whole picture. This isn't just a simple change of heart. What we're seeing is a strategy that experts are calling litigate then partner. The key here is that the initial lawsuit wasn't necessarily meant to shut down the new technology forever. Instead, it was a powerful negotiation tactic. By suing first, Warner Music put immense pressure on Suno, using the threat of legal action as leverage to secure a more favourable partnership deal. This move signals a major shift, suggesting a new playbook for legacy media companies to manage disruptive AI. Instead of just fighting it, they can use their legal power to guide it and profit from it. If that was just the appetizer, the main course is just being served. The core of this deal is a bombshell. Warner will now allow Suno's platform to use the voices and likenesses of its artists who opt in to create new AI-generated music. Here's where it gets interesting. This opt-in model could fundamentally reshape the music industry's job market. So the thing is, this is likely to create a split. For superstar artists, licensing their digital voices could become an incredibly lucrative, high-margin new revenue stream. But for emerging and mid-tier musicians, the flood of low-cost AI-generated content could dramatically increase competition, making it even harder to build a career. This could deepen income inequality within the creative world. The stakes here are massive. Suno isn't a small player. It's a 2-year-old startup with around 100 million users. The music industry has been in uproar over this technology, with over 200 artists, including Billie Eilish and Nicki Minaj, signing a letter to stop the predatory use of AI. They argued it was a trend that threatened the entire music ecosystem. What really brought this to a head was the financial implication. This deal is changing the very definition of a music catalog's value. Traditionally, a song catalog was a passive asset, generating royalties over time. But with AI, it transforms into an active asset. A company's intellectual property, its library of songs and artist likenesses, can now be used to actively generate new licensed works. This could force a complete repricing of media catalogs across the board, making the IP of companies like Warner Music even more valuable and potentially sparking a new wave of mergers and acquisitions. But the rabbit hole goes deeper. Starting next year, Suno will roll out advanced license models. While free plays and shares will continue, users will have to pay for audio downloads, creating a new revenue stream where artists who opt in will be compensated. This isn't just a settlement, it's a strategic pivot that splits Warner Music Group from its former allies in the lawsuit. The situation presents a fascinating duality. On one side, you have other labels still fighting the AI wave, while on the other, Warner has decided to ride it. Believe it or not, Warner's move could trigger a race among the major labels to create their own exclusive partnerships with AI startups. This could lead to a series of walled gardens where access to the catalogs of top artists is tied to a specific tech platform. We saw a similar dynamic in the early days of streaming music services, but this time the walls could be even higher, built on proprietary AI models and exclusive licensed data. Warner Music has made its choice. By settling its litigation, it has broken ranks and placed a massive bet that the future of music creation involves collaborating with the very technology once seen as its greatest threat. Now, the model Warner and Suno are building in the US is just one possible future. We need to look at the global picture. And speaking of which, China is developing its own distinct state influence model for generative AI. While the US relies on private licensing deals, China's approach is more top-down, with platforms like Baidu's Ernie Bot operating under government oversight that aligns AI-generated content with national values. The winning global standard for AI content will ultimately determine the flow of royalties, data, governance, and the balance of power in the creative economy. For Chinese listeners, this means our domestic tech platforms and regulatory environment will play a huge role in shaping the AI-generated content we see and create. As with all emerging technologies, the market impact remains dynamic. This information is for informational purposes only and does not constitute investment advice.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.